A CD is basically going to be, unlike a stock or something, this is going to be more of an account that provides, I want to put this, a set interest rate but there's a cost to this. In exchange, that the money is left. Long definition here, sorry about that. In the account untouched for a period. I swear I'm going to stop writing. I even kind of slowed that down a little bit. So while you're kind of jotting that down, let me try and explain some of the stuff I actually cut out. So when you have a CD, you're going to go into the bank and they're going to say, hey, we'll give you 6% interest, but we want you to leave this money in this account and not touch it for like 2 years or a year, or it can be different time periods. And if you take it out, you get penalized. You may be penalized all of your interest. You may be penalized part of it. So there's an opportunity cost to the guaranteed rate that you get. So it's one of those things, again, lower risk, but there's some opportunity to it, which kind of discusses in this second part when it talks about the penalty for early withdrawal. But yes, there's definitely a penalty, but those fees can vary. So it can be part to all of the interest that you have earned, depending on the length of it. So you've got to be cautious when you get involved with a CD. Hey, what's the penalty if I withdraw money? That's why we always say when you're investing, only invest money you can afford to lose or not have for a time period. So if you're living paycheck to paycheck, you don't want to be investing, because if you got to go get the money back, you might actually be losing even more in the process. So that can vary a little. And then how long do you have to leave it in? It depends. But it can be, it's usually a few months to several years. And usually the longer you're willing to leave it in, the larger of a percentage you're going to be guaranteed. So a 6-month CD is not going to pay as much as a 2-year CD would, or things like that. So a little bit to kind of take into consideration there. So as far as safety goes, they are safer than stocks and bonds are. Bonds are even pretty safe. We're going to get to those too, but definitely safer than stocks. But you're going to get a lower return for the fact that you're taking a lower risk. So you're guaranteed, how do I want to put this? I guess I am going to write this. Guaranteed returns are going to be your positive here. If you're trying to find a reason, you're like, well, if I'm not going to make as much money, why the heck would I want to be in a CD? Because it's lower risk. You're not going to lose money on a CD. So you have a guaranteed return. It's just going to be a smaller one, and you're going to find that out as we get into some of the numbers here a little bit with these. So to figure out these, whether it's how much interest you earned or the amount of the CD, depending on, what information we have. Not going to be real complex. As you can see, we got a little chart here to help us again, like we had in the last section here. So with this, you're going to take your original amount that you had, your original principal, times the amount per dollar, which is this chart that we've got here. Because again, bankers have calculators that have particular programs and things in them to help them calculate things quickly. We don't have access in here to those. So we're going to be using these charts to help us do the calculations a little bit easier. And so your interest earned is just going to be the amount of the CD minus your original principal. Sort of like when we said before, the interest you were paying on things. Hey, how much was my loan? How much did I pay back? We subtract them. Same idea here. Hey, how much was the CD according to this chart minus how much I put in, and that's going to let me know how much money I made. Like I said, we're going to see here kind of how the basic percentages are going to work. We're not going to be millionaires off of these. I'm going to guarantee that. So as we get into some of the example stuff, all right. Kamala invests $1,000 in a one-year CD that earns interest at an annual rate of 3%. Yeah, these 3, 4, 2.5% are pretty normal for a CD. Compounded quarterly. What is the amount of the CD at the end of the investment? So, when we're looking at this, there's my initial investment. Okay, there's my original principal. And then we're going to be getting this 3%, but we're not going to do 0.03 like we have been. This is going to help me figure that out. So I'm going to come here and I'll be like, all right, annual rate, 3% compounded quarterly. So yes, we're going to take all those decimal points. And I'll explain the difference in these columns in a minute once we get our first amount set here. Definitely going to need calculators for this with all these decimals. I'm not even going to attempt to try and figure this out without calculator here. So basically what I'm telling you is, if you invested $1,000 at the start of the year in this particular CD, you're going to make about 30 bucks on it. But here's where the difference comes into play versus what we used to do. What we used to do, we'd have taken 1,000 and we'd have said, hey, it's at 3%. So we'd have said, all right, so 0.03 is 30 bucks. And we'd add that to the 1,000. You're like, seriously, Hardy? There's like a 34-cent difference. Why is there a 34-cent difference? Because this interest is compounding. So when you get your interest this month, next month when you go to get more interest, it's putting interest on the interest. That's the idea of compounding. It's not just the flat 3%. You're also getting it on that extra. So I know the $1,000, it seems worthless, but you get into tens of thousands, hundreds of, it starts to make a difference, especially if you can get a little bit higher of a rate. So what we're going to need to do, and we'll do one more of these. We don't need to go crazy with them. So Olympia is popping $3,000 into a one-year certificate of deposit. Interest rate, 4.5%, compounded monthly. We've got to pay attention to that word because, yes, it's very slight, the differences in some of these, but again, bits of money can add up to a lot if we're not careful. So 4.5% monthly. So here we go. Make sure I copy that right. So again, I mean, let's see. Is there a ton of difference, Hardy, if we were just making the flat 4.5% versus, again, a couple of bucks here and there, but a couple of bucks here, a couple of bucks there, we start getting a little bit more. Now, that's finding the amount, figuring out, hey, what's this CD going to be worth at the end? The other thing I can do is, depending again on the information I have, I can find out how much the interest was that I earned. So, two steps to play with here. First, do exactly what we did up here. So we're going to find the amount of the CD. So we're like 2% monthly. 2% monthly. So and just like we did when we were in the middle of our last unit, now to find the interest earned, you just take the amount of the CD at the end of the year and subtract how much you put in at the beginning. And you start to see why a lot of people look at CDs. When I do my personal finance things, I actually call them certificates of depression. And here's why. Nothing terrible with them, but typically the interest rates that are earned with them will barely keep up with inflation, if that even. So like you're making 2%, but the prices of things are going up 4 or 5. Yes, you're getting more, but it's not enough, especially when you're clogging up that much money for that long. So unless you have a load of money and you're just trying to make sure it's safe, this may not be the best option ever. So one last one, and then I'll let you play a little. I'll show you the other thing with the stock market terms too. We'll get you set. So 3,700 bucks. All right. 4% quarterly. 4% quarterly. 1.040604. Let's see here. So 3,850.23. And again, it's just going to be those two numbers that I'm messing with basically here. So CDs by far are going to be the simplest calculations that we do because there's not a lot of complexity with it. And work that through. I even could, if I was told ahead of time how much I made at the end of the year, I could figure out how much I had at the beginning. So your job kind of playing with this over here on the practice, and again, I don't need you to go crazy. So like if you're working back here on page 2, there's 3 of those. If you do 2 or 3 of those, there's 1, 2, 3, 4, 5, 6 of these at the bottom. Okay. Again, we don't need overkill. 3 out of the 6 down there, 2 out of 3 up here, just to get used to more of the chart than anything else, and just the setup. So when we're doing them later, you may not have to go look at something else. Would be the best route I would send you on this. The other thing I'll mention, I'm not going to require it, and I put it this way on the classroom stream as well. as we go through this unit, there's a lot of terminology that gets mentioned that sometimes can be tricky to understand, and I try to explain it as best I can as we go, but at the same time, so over on page 3, and I've got it in a smaller version that you can actually see on the stream, this is the types of terms we're going to be dealing with, especially when we get into the stock area of this. And it's important that you kind of have a little bit of background on it. So instead of you needing to go and look up all this stuff and find a site that has it and see what it's got, I went ahead and did it. Again, I'm not going to be looking for it when I turn stuff in, but having it could make things make a lot more sense when you get there. So what I did, maybe, if I can get out of here, there we go, is I went ahead on the mainstream of Classroom, and I've got it here. I just have it in a format where you can see it when you want to. Maybe you just put a couple down here, a couple down there, and by the time we get done talking with stocks, you have them all. Because it's a nice thing to have future reference anyway, if you start doing some savings and investing on your own when you get a little bit older, get that full-time job, and have a little bit of money to work with. So take advantage of the time.